Thank you very much for joining us once again. Welcome back. What we are discussing today, we are discussing a real estate investment trust. We have already discussed a fund, basically investment fund. Then in the previous lecture, we'll discuss that special treatment for the real estate investment trust, and we'll be discussing in our coming webinar. This webinar is regarding that. So whatever we have covered till now, we have covered almost in the 71 webinars, we have covered so many things. In the last webinar was qualifying investment fund and its taxation on stakeholders. Today, as I mentioned, we are discussing real estate investment trust. Investment fund, we have already discussed in our previous webinar what is investment fund. Investment fund is a fund where the peoples are pooling their resources, hiring investment manager. Fund is making investment. From the investment, they are getting return. Then it is being distributed among the investors. Feeder funds, it has been mentioned in the guide. Feeder fund, this is another, basically within the fund they are creating one more master fund where they are again pooling their resources, from there making the investment. If the feeder fund is satisfying the conditions to become a qualifying free person, feeder fund can apply to the FTA as well, and the feeder fund can enjoy to be an exempt person. Stakeholders of investment fund. What are the stakeholders? What are the parties that are directly related to the investment fund? These parties are the investors, investment manager. Investors, the people who are investing the money. Investment manager, they are the people's companies who are managing the funds. Investment sub-advisor, these are the advisors who are supporting the investment managers. Sponsor could be responsible for establishing and overseeing the fund. The custodians are the people's companies that are holding certain assets on behalf of the funds, or they are performing some administrative task. All these things we have discussed in our previous webinar. Investment fund in the UAE, we discussed there are public funds which are available to the general public. Everyone can buy and invest in the funds. Private funds, these are available only to the professional investor. These are generally not available to the general public. These are called private funds. Open-ended funds have variable capital that increases according to the new issued unit or decreases by the redemption of the units. This is open-ended fund, and closed-ended fund has a specific capital. It cannot increase and it cannot decrease unless and until special approval has been taken. So these are called closed-ended fund. Investment funds can be based on the specific investment themes. These various types of investment funds, like it has been given in the guide: private equity funds, venture capital funds, private credit funds, infrastructure funds, real estate funds, umbrella funds, ABCD. You can go through this. The various types of funds based upon the specific purpose, a specific theme of investment. What the law says, what the UAE corporate tax law says about the investment fund. They said investment, and Article 10 of the law deals with the qualifying investment fund. It has been written in the law. An investment fund may apply to the authority, to be exempt from the corporate tax as a qualifying investment fund where all of the following conditions are satisfied. These we have discussed in a previous webinar as well. The first one is the regulatory oversight by the competent authority in the UAE or out of the UAE. Second was the funds is registered on the recognized stock exchange or widely distributed among the investors. Third one is the application that is being submitted to the FTA. The main purpose is not to avoid the corporate tax. The fund has been established not to avoid the corporate tax, basically. These three conditions are very straightforward. Regulatory oversight, we discuss the regulatory oversight, we discuss again various authorities, widely distributed. Basically, the fund is not in the hands of the specific people, but this is widely distributed among the public. And the fund has not been established to avoid the corporate tax. These are three main conditions. And in the D1D, 10(1)D, which is here, 10 1D, they said any other condition that has been specified by the minister. Might be, they said any other condition. And just in pursuant of this condition, 110(1)(d), one cabinet decision was introduced, and this cabinet decision was 81 of 2023. This was issued in continuations of 10(1)(d), Article 10(1)(d), and this cabinet decision deals with the non-real estate investment trust and real estate investment trust. Basically, this is the specific real estate investment trust, and these deals with the all other funds. So this these three conditions, these are common conditions. One is the regulatory oversight. This if the fund manager under the regulatory as competent authority. They are security and commodity authority for the funds which are registered out of the DIFC or ADGM. If the fund registered within the DFC, the regulatory authority is DFSA, DFSA. If the fund is registered within the ADGM, then the regulatory authority is FSRA, Financial Services Regulatory Authority. They said the fund should be of the regulatory or the competent authorities within the UAE. These are the three authorities. Authorities can be outside of the UAE as well, but must have the equal recognition like the authorities in the UAE. Then they said fund's ownership objective was diversified ownership, and it should not be in the hand of the specific people. Recognized stock exchanges are Abu Dhabi Security Exchange and Dubai Financial Market, Nasdaq, or any other stock exchange of equally the standard of the UAE. The fund should be registered on the recognized stock exchange, or this is widely distributed among the investors. Main purpose is not to avoid the tax. And the fourth condition, into further condition, has been implemented under the Cabinet Decision 81 of 2023. And we can classify these conditions into real estate investment trust and non-real estate investment trust. In the non-real estate investment trust, all other funds will be covered. So what were the conditions of the non-real estate investment trust? It was we were discussed in our previous webinar. The primary condition, four conditions were there. The primary business of the investment funds involves conducting investment and related activity. This is the primary business. They are thoroughly focused on the investing activities. Then investor conditions were there that if the investors are 10 or less than 10, and they and the related party maximum, they must be holding 30% or less than this. And if the investors are more than 10, then the investors and their related parties, they should not be holding more than 50%. The third condition is the fund must be managed by an investment manager and supported by 3 investment professionals, and the investors are not involved in the day-to-day management of the fund that we have discussed in our previous webinar. What is new today? New today is real estate investment trust, and there are separate conditions. There are some common conditions. Common conditions are four under the Article 10(1). These are regulatory oversight of the competent authority. This is the first condition. Second condition, registered under the recognized stock exchange, are diversified and available to the public. Third, the fund has not been established to avoid the corporate tax. And fourth condition are, these three are common conditions, and these rest are specific conditions. This specific condition can be classified REIT and non-REIT. Non-REIT conditions are these four conditions, and REITs conditions are these three conditions. Real estate investment trust. If your fund is established for the real estate investment trust, these are three main conditions. Asset value condition means the portfolio that the fund is managing, it should not be less than 100 million, excluding the value of the land. This 100 million, how we can calculate it, we'll be discussing in our coming slides. This is the one asset value condition, means the portfolio the fund is managing. They are not asking fund is owning. They are asking owning, but they are asking the fund is managing other than the value of the land. It should be more than 100 million. Second, ownership condition. Ownership condition is basically 20% or more of the share capital of the REIT is floated on the recognized stock exchange, or it is being managed by 2 or more institutional investors that must not be a related parties. So objective is basically fund is being freely available in the recognized stock exchange, mean anyone can buy, from the recognized stock exchange means diversified investors are there. If the investors are not diversified, then institutional investors should be there, at least two, and these should not be related parties. So any of these two conditions, one this or this, any of these two conditions must be satisfied to be classified, to satisfy the criteria to be classified as a qualified real estate investment trust. So first condition is asset value condition, portfolio more than 100 million, ownership condition 20% are directly owned by the institutional investor. Any two of one of these condition needs to be satisfied. And third is the assets that are being utilized to generate the real estate investment income, those assets should not be less than 75% of their total assets. I'm repeating, the assets that are being used to generate the real estate investment income, those assets should not be less than 70% of their total assets. And when I'm asking about the real estate investment income, it will not be including any gain, any loss from the real estate. So other than gain and loss from the real estate means on daily basis they are buying, selling. So those gains and loss, basically such assets that are being used, it will be considered over the total asset. The annual, basically, I put it a REIT. A REIT basically annual real estate asset percentage, it should be at least 70% in the overall 1 year or in the Gregorian calendar year. So I have used the word here institutional investors. I will just discuss what are the institutional investors. Institutional investors are government. It can be federal government or it can be local government as well. Then government entity and government controlled entity falls under the institutional investor. Then foreign government institution authority or entity falls under the institutional investor as well. International organizations, they are part of the institutional investors. Banks are there, insurance providers, there are pensions or social security fund, and licensed investment activity means any other qualifying investment fund can be there as well. So these are the institutional investors. They said 20% of the share capital of the REIT is floated on the recognized stock exchange, or any two of them are holding the ownership of the fund, but these two are not related parties. Just keep in mind, a related party, we can go up to fourth degree of kinship as per the UAE corporate tax law. A REIT, annual real estate asset percentage, this is basically real estate income excluding real estate gains, generating asset divided by total value of the asset. As I mentioned earlier, the assets that are generating a real estate income other than the real estate gain. Gain will be basically you have the asset, the value of the asset is going up and down, you are making gain if the value of the asset is going up. But if you are day-to-day sale purchase, that is not gain, that is the straight for a different thing. This is operational income. So real estate income excluding real estate gain, the assets that are generating real estate income excluding the real estate gain divided by the total value of the asset, it should not be less than 70% on overall basis over the period of 12 months. There is a possibility, might be for the first quarter you are getting 60%, next quarter you are getting 80%, next quarter you are getting 50%, then next quarter the REIT is basically 90%. They are asking on overall over the period of 1 year, it should not be less than 70%. These conditions needs to be satisfied. If these conditions are being satisfied, then we can say the real estate investment trust. If the real estate investment trust is satisfying the three common conditions that were discussed earlier, then the real estate investment fund is satisfying these conditions as well, then the real estate investment trust can apply to the FTA to be classified as a qualifying investment fund. And if the FTA is approving it, will be considered exempt for corporate tax purposes. If I'm discussing conditions one by one, this is asset value condition. Asset value should be exceeding 100 million. It should not be considering the value of the land. It has been given in the guide that this 100 million can be calculated based upon the carrying value of the real estate as given in the financial statements. Legal title of the real estate is not compulsory. Law is using the word REIT is managing the real estate. They are not, ownership is not compulsory. Holding and managing of assets through SVP are allowed. There is the one fund, Fund A. This fund is another fund, Fund B. Investment is being made through B, and B is satisfying all related conditions. And whenever this net income is being distributed among the investors, B is showing A and B consolidated results are being showing on based upon the consolidated results, net income being distributed to the investor. If this is the case, then the law says the assets that are being utilized by B, those assets will be considered as well to assess this 100 million portfolio. The same has been written. Allocation of the net income to investors on its consolidated financial statement. Yes, real estate assets held by such exempt persons are considered if the net income is not being distributed to the investors on overall basis, but separate A is distributing based upon A, then this B assets will not be considered. Ownership condition, as I mentioned, 20% or more of the share capital REIT is floated at the recognized stock exchange or directly owned by two or more institutional investors who are not related party to each other. And these are closely held and restricted share. These are, when I'm asking floated on the, means these are generally available to the public. If this is the restricted script, if this is a restricted unit, they are closely held and restricted share. These will not be considered that these are floated on the recognized exchange and freely available to the public. These held restricted share will not be considered as a part of the ownership of 20%. Institutional investors, I have already discussed with you what are the institutional investors. Third condition is asset percentage condition. The asset that are being used to generate the real estate income other than the real estate gain, it should be at least 70% of the total assets. This is the formula I reproduces again. Real estate should be as a reference to the immovable property. We know the definition of real estate property. Should be determined based upon the carrying value of the real estate given in the financial statement. Yes, 70% average position. It should not be a specific quarter, though. We need to look on overall on the over the period of 1 year. Hold and manage its real estate asset through fully owned SPV. The same conditions applicable is there as well. If the SPVs, special purpose vehicles are there, there is one fund, another fund. This fund is SPV. Net income is being distributed on overall financial statement basis. Then we need to consider the assets of the SPV as well while calculating this 70%. I have prepared this summary for you. This is whatever we have discussed in our previous two webinars. The question is, start with the investment fund. Is this investment fund? How will you able to know this? You will be able to know this from the investment activity of the entity. Then the second question you need to ask yourself, how it has been restructured, how it has been structured. While looking into this, you will be able to assess it has been structured as a juridical person, or it has been structured as an unincorporated partnership, a sole establishment, or unincorporated partnership. There is a possibility, yes, this fund has been structured as a juridical person. No, if the fund has not been structured as a juridical person, means this is an unincorporated partnership. Partnership itself will not be subject to tax. We know this. There is no difference between the individuals and partnership. Be treated like an unincorporated partnership. Income will be taxable in the hand of the partners. Partnership itself will not be subject to tax. Sorry guys, I have flu today, so apologies for this. So the next one is, the next question is, this is an investment fund. Yes. Structured as a juridical person. Yes. If it has been structured as a juridical person, then we need to look into this. Is this fund is satisfying the common conditions as per the Article 10 of the law? And these common conditions are regulatory oversight. We have discussed, traded on the recognized stock exchange, and not to avoid the tax and any other condition. So this is a common condition for both REIT and non-REIT. All these conditions are being satisfied. If these common conditions are not being satisfied, then fund will be treated like a normal juridical person. So this fund cannot apply to the FTA to be classified as a qualifying investment fund. If these common conditions are being satisfied, then we need to look into this is a REIT or this is a non-REIT. If this is a REIT, we know the condition. These three conditions for the REITs are portfolio they are managing other than the land 100 million. 20% of their share capital is floated on the recognized stock exchange or held by two institutional investors which are not related parties. And the third condition is their REIT, annual real estate asset percentage is at least 70%, which is not including the gain, which is not including the assets that are generating gain basically. So which is not including the assets that are generating only gains, other than those assets will be included. So these Article 10, these conditions are satisfied. REIT conditions are being satisfied as required under the Cabinet Decision 81 of 2023. If these are being conditions are being satisfied, then the REIT can apply to the FTA to be classified, to be qualified as a qualifying investment fund. If FTA is approving, then it will become a qualifying investment fund and income will be exempt for corporate tax purposes. If the Article 10 conditions are being satisfied, okay, then this is a non-REIT. Then these conditions are being satisfied as well. Then it will be, then this non-REIT, any other fund can apply to the FT, and if the FT is approving, it will be considered a qualifying investment fund. Otherwise, it will be subject to tax like a normal juridical person. And these conditions are primary businesses undertaking investment. Investor less than 10 or equal to 10, they should not be holding at least more maximum 30%. And they should not be related parties. And more than 10, they should be holding maximum 50%. Investment manager must have 3 investment professionals, and daily management is not in the hand of the investors. Then based upon this criteria, we can assess. What can we assess? Which fund can apply to the FTA to be considered a qualifying investment fund? Which are the transparent entities and which are be treated like a normal juridical person? Now the tax treatment. Tax treatment for both of the funds is same. Whatever we are discussing in a previous webinar, there is no change for the tax treatment for the qualifying investment fund. Even this is a REIT, even this is a non-REIT. Unincorporated partnership will be treated like a natural person. Income will be taxable in the hand of the individual. Partnership itself will not be subject to tax. Juridical person, yes, partnership can be subject to tax if the partnership has applied to the FTA to be treated as a taxable person. We are talking about the unincorporated partnership, which will be treated like a transparent. Then juridical person, if the qualifying investment fund is a non-qualifying investment fund, there is a possibility the investment fund is a non-qualifying investment fund. It will be considered like a juridical person as we discussed in our previous slide, like any other LLC. If this is a qualifying investment fund itself will not be subject to tax. Resident qualifying investment fund, worldwide income will be subject to tax. Exempt income will be exempt basically. Exempt income taxable in the hand of the investors like a transparent over here. If non-resident, then exempt income will not be subject to tax. Non-resident qualifying investment fund will be generating income, can be generating income through the PE source or nexus in the UAE. If the non-resident qualifying investment fund is generating income from any source, this income will be subject to tax. Other than this, any income will not be subject to tax. Taxation for investor, we discuss treatment for the investor purports share of net income. The fund needs to prepare the financial statement, classify the income into exempt income, interest income, income from the immovable property, other income. Based upon this, they need to deduct the expenses. After deducting them, what are the net income? This and net income needs to be distributed among the investors. Once this is being distributed among the investor, then we need to look into this. Whenever the investor was making the investment, does the investor need any license from the authority? No. If they are not in need of any license from the authority, then it will be considered an investment in the personal capacity, and this will not be subject to tax. But if yes, if they are the investor are required any license, then we need to look at this is a resident investor or non-resident investors. So resident investors, exempt income of the fund will remain exempt in the hand of resident investor as well, and taxable income of the fund will remain taxable in the hand of the resident investor. Non-resident person, exempt income will remain exempt, and their only income that will be subject to tax, it will be income from the PE sources or nexus in the UAE. That income will be subject to tax, otherwise it will not be subject to tax. If exempt person should hold investment in a qualifying, as I mentioned, there is one fund which is qualifying investment fund, this fund, another qualifying investment fund, this fund is further making the investment. So if this fund is satisfying the criteria, this fund needs to apply to the FTA separately to be classified as a qualifying investment fund, even though 100% owned by one qualifying investment fund. And this fund itself is satisfying the criteria needs to apply to FTA to be treated as a qualifying investment fund. While considering the total asset percentage of criteria that were discussed in our previous slides, we need to look into this. The net income that is being distributed to the investor, is this based on the overall consolidated results or individual? If the net income shows consolidated result, then we need to consider the numbers of this SPV, special purpose vehicle, as well. Investment manager and other stakeholders, like a typical company generating income, resident, non-resident, natural, juridical, less than 3 million, more than 3 million, small business relief, all these things will be applicable on them. It will be treated like a normal business for them. They are providing services. And this is the services might be either mentioned by the natural person, company. So this is the service criteria applicable to them. Allocation of net income that we have already discussed. The other provisions of the law which has been given in the guide. What are those provisions? They said distribution. There should not be a dual taxation to the investor if the distribution has been made, and any distribution made by qualifying investment should not be included income. One income needs to be included, treated one time, not two times. We'll look into the example as well. If the distribution is lesser than the income, it should not be subject to further taxation. If distribution is more than the income, then it should be subject to further taxation. Combined basis of net income, we need to look at the result on overall basis, combined starting from day one instead of the individual year. So on overall basis, how much net income they have recognized and how much is the total distribution, we need to look into the as on numbers. If the distribution exceeds the amount of net income, they will be subject to further tax, individual investor. Disposal of ownership. If the investor, that is a taxable person, realizes the capital gain from an investment in the fund, then we need to look at are they satisfying the capital investment condition, this participation interest condition. If they are satisfying, then it will be exempt, otherwise it will be subject to tax. Exempt person. Fund is an exempt person in various provisions of the law, like how to calculate the taxable income, how to map the accounting income into the taxable income. All these provisions, so many other provisions of the law will not be applicable on the qualifying investment fund. In exempt person net income, a juridical person incorporated in the UAE that is wholly owned by qualifying investment fund can also apply to be exempt person, as we did, but they need to apply a separate, as I given you example as well. One fund is there that is creating another fund, 100% owned by the first fund. The second fund needs to apply separately to the FTA. Net consolidated income. I think we have already discussed the criteria on this as well. We already discussed the criteria, the net consolidated income. If the net income being allocated, distributed to the investors on consolidated basis, then we need to consider the numbers of the other fund as well. Aggregation of net income. If source and consolidated financial statements are available, the net income of qualifying investment from exempt subsidiaries shall be aggregated in a manner similar to consolidation. If it has not been consolidated, they said then we need to consolidate by considering intra-fund transaction should be eliminated, and dividend received from the exempt person should be eliminated as well. Clawback, two parties were there. One company was here, one fund was here, another fund was here. Both were basically under the 70% common ownership, assuming 70%, both were the funds. And this fund has transferred any asset liability to this fund at the book value. Then if any of this fund is becoming qualifying investment fund, once they are becoming qualifying investment fund, then they cannot enjoy any relief. So whatever the transaction that was executed at the book value in the past, then they need to consider the gain based upon the market value. it should be considered by the investor, and if investor is not available, then it should be, sorry, it should be considered by the transferor, and if the transferor is not available, then the gain needs to be considered by the transferee. This is a common provision of the law clawback. Tax group, either they were part of the tax group, now they could becoming a qualifying investment fund, then they need to leave the tax group. In the same way, if the fund investment fund was parent company of the group, now the investment fund is becoming qualifying investment fund, they will no longer be remaining the parent company, and the group will be dissolved unless and until any other member of the group is becoming a parent company of the tax group. The clawback will be applicable on the tax group as well if there were any transactions in between the group member that was considered at the book value or transfer were made at the book value. Any gain was not recognized. So if the any one fund investment fund is now becoming qualifying investment fund within the 2 years from the date of the original transfer of original triggering or initiation of that transaction, then clawback will be applicable and transaction needs to be treated at the market value. Transferor needs to consider the gain. If the transfer is not no longer existing, then the transferee needs to consider the gain. Existing losses are unutilized net interest expenditure they cannot carry forward while becoming qualifying investment fund. And once they are no longer as a qualifying investment fund, then they can carry forward the unutilized losses with existing losses, unutilized net interest expenditures. The same provision is applicable for the tax losses as well. So once they are becoming qualifying investment fund, they will become exempt person. Once they are becoming exempt person, they cannot carry forward the losses, net interest expenditures before becoming qualifying investment fund. Once they are no longer the qualifying investment fund, then they can carry forward. Limitations are there. They cannot form up the qualifying group, cannot form up the tax group. They cannot enjoy the relief. They cannot carry forward the losses as we discussed, as we just mentioned. So we will go through the guide quickly. There are so many things to discuss in the guide as well. Okay, we'll go to the illustration straightforward directly to the guide. We'll not be going further into detail. We'll be going through the illustrations, examples given in the guide. This is the structure. I think we have discussed earlier as well. Investors are their sponsor, guard, custodian, GM, general partner, trustee, investment fund, investment managers, and sub-advisors. This is the first, as we discussed earlier, if the license is not required and natural person is holding any investment in the qualifying investment fund, the income in the hand of the natural person will not be considered taxable. It will be considered their personal income. The same example they have given it here. Natural person based in the UAE invest in a qualifying investment fund where they earn the income from investment. It doesn't require any license to make such an investment. The income derived by the natural person is personal investment income and accordingly is not subject to corporate tax. So this example we discussed in our previous slide. The 15 investors that their income has been classified into the 4 categories. Then 22.2 is exempt income, interest 5, immovable property 15, other income 7.5%. There are 3 different types of investors. 13 investors holding 20%. One is holding, which is a UAE incorporated resident person, 40%. Another investor is holding 40%, which is a foreign juridical person. The same thing they have classified. This is the income classification, 40%, 40%. This 40%, 2%, 6%. This is 40% of this total income. Then this is the, as we discussed earlier, this is non-resident investor. Once the investor is a non-resident, their income will be subject to tax from the PE, any UAE sourced income or nexus in the UAE. So their net exempt income will remain exempt in the hand of the non-resident investor, and net interest income will not be subject to tax as well, because only 3 types of incomes are taxable in the hand of the non-resident investor. It has been mentioned in this example, net exempt income, net interest income, and all other net income is not included in investor to income, as it is not attributable to the nexus in the UAE. And in the above, it has been given that the non-resident person is not generating any income from the PE and UAE sourced income. So only nexus in the UAE in the form of immovable property, this income will be subject to tax. This related to the REIT, real estate investment trust. This the same thing is there. Anyway, income is from the net interest 2.5. Immoral property 47.5, investor 20%, 40%, 40% if you are going into the detail. The same thing they have concluded here as well. So 2.5, 47.5, 40% is 119. This income is not taxable. Only taxes in the UAE that income is subject to tax for the non-resident investor. Time apportionment is given. We have discussed in a previous webinar as well. You can go through the time apportionment. Nothing is important here. You can go through this. Inclusion of distribution. This is important that we discuss the distribution. Once income has been distributed, it should not be subject to tax again in the hand of the investor. So in 2024, this is the income. 25, this is income. 26, this is income. 10% held by ALLC. 6, 1, 5, this is 10. We need to consider, as we discuss in our presentation, we need to consider an overall basis. The total distribution of 50 out of this ALP 5. Now A has already considered income of 7, 6 in 2024, 1 in 2025. 7 income, it has already been considered by ALLC. If distribution is being made to ALC 5, then ALCC is not subject to pay tax on this because they have already considered 7 in their taxable income. In 2026, the total income that has already been considered by ALC is 10 plus 1, 7, 11 plus 6, 17. And total distribution of 13, still they are not liable to pay any further tax. The same thing they have given here, this see, received total is 13, which is 13 is equal to 10. 13 is the total distribution, 8 plus 5, 13, and total income is 17. They have given it here as well. You can go through this. Therefore, ALC shall not include the distribution actually in its net income because they have already considered a net income in their financials. They have already paid the tax. Corporate tax arising from season to be part. This is important, like one A and B, one part of the group, a part of the qualifying group. Out of this, one entity has become qualifying investment fund. They have made a transaction within the last 2 years. The value of the transaction was 30 million, but the market value was 5 million, but they have transferred the book value in between A and B. Gain of 5 was not recognized because A and B were part of the qualifying group. Now A LLP, which was the transferor, is leaving the tax group. Sorry, leaving the qualifying group means they are no more under the 70% threshold. So once they are not part of the qualifying group, means whatever the transaction that has been executed in the past 2 years, this transaction gain needs to be clawed back. Initially, ALLP is liable to pay the tax. If the ALLP is not existing, then transferee, which is the BLLC is liable to pay the tax on 5 million. So they have put it here. A and B were part of the qualifying group. A is no longer part of the group, but within the last 2 they made a transaction. Now ALP is exempt. It means ALP will not be paying any tax on the gain. So on behalf of A, B, LLC will be liable to pay tax on this extra 5 million because initial transaction at the book value. They have given it here as well. Then as a result, gain of 5 million will be included in the taxable income of BLLC in the tax period this. So this is the clawed back that we discuss. You can go through this fund ownership conditions, investment business conditions. Investment business conditions. This is investment business conditions. The core is basically, whenever we were discussing the non-REIT, the first condition was the core is basically investing condition. This is the core. This is the further non-REIT. This was first condition was there. This example pertains to that. They said the fund has by 100 million, invested 100 million. It means in the 2024, the fund was involving for satisfying the investing condition. In 2025, even the fund has not made any investment, no the income of sale from the shares or any other activity. They said still it will be considered that the fund has satisfied the overall conditions because based upon the asset held, cost incurred, time spent by the management, still it will be assumed that the fund is satisfying the investing conditions. Investment business condition in the feeder fund. The ALLP, BLLP, you can go through this. This is the CLLP individual owner, DLLP companies owner, ELP investors owners, BLLP individual owner, all together making investment in ALP. ALP further investing into the share means ALP satisfying the investing conditions. Some companies are out of this investor. They are only investing in ALP, means those are satisfying the conditions as well. So you can go through this, which parties are satisfying the business investment conditions, which parties are not satisfying the investing conditions. Ownership combined through the related party. This is the ownership satisfying. We should discuss basically if the REIT or non-REIT. Non-REIT ownership should be 30%, less than 10 people, more than 10 ownership will be maximum. 50% related party will be treated one party, not more than one party. So A owns B, A is holding into X, A is holding into the C, A, B, C are related parties. Principally, apparently, it looks like 8 investors are here, 1, 2, 3 are there, total are 11 parties. But since related party are one party, so total are 8 plus 1, 9 party. This one party should not be holding more than 30% of the total investment in XLLP, and they are holding 5 plus 15, 20%, 20 and 25% of 20%. 25% of 20% will be 5%. So on overall basis, this group, one related party, all related party, which will be considered one investor, they are holding 25%, and the maximum they can hold up to 30%, means diversity of ownership condition is being satisfied as well. You can go through here. They have said it does not entirely hold an aggregate ownership more than 30%. They are holding 25%. How 25%? 5 plus 15, 20 into 20 into 25%, 5. 5, 5, 10. 10 plus 15, 25%. So diversity of ownership condition is being satisfied. Diversity on a feeder fund is the same thing applicable here as well. You can go through this. Parallel funds. You can go through this diversity of ownership condition in the parallel funds. You can go through this. Institutional investors. For the institutional investors, see, ELLC is controlling BLLP, controlling CLLP as well. They have directly investment in ALLP. So E, B, and C, they are related party. It will be considered one party. DLLP is not a related party. So how much investment? They said ELLC has control of B and C. This party has control of B and C. BLLC are related parties. However, D is not a related party of LLP. Therefore, ALLP has at least two owners that are institutional investors that are not related parties. Therefore, REIT ownership condition is satisfied. So the ALLP has this one owner, and this all related party will be treated one owner. So these are at least two owners which are not related parties. So ownership condition is being satisfied. This is the condition for the REIT. REIT condition, ownership condition 20%, or two institutional investors which are not related party. This is application of that provision of the guide or law. There is one more. ALLP is holding 100% in B. ALP is holding 100% in C. C is non-resident juridical person. B is resident. D is resident. E is non-resident. Basically, E is resident but own 100% in C, which C is non-resident juridical person. So what they said, BLP, the juridical person incorporated in the UAE, directly owned and controlled by ALP, engaged exclusively holding asset on behalf of ALP. This is, I think, provisions of the Article 4 1H, where they said any entities which are exclusively being set up 100% owned by the qualifying investment fund, exclusively being set up to support them in their day-to-day activity, the qualifying activity, that will be exempt as well. So this entity has been set up. ALLP is a qualifying investment fund, B, D, C, E. The important condition for this is they said these entities must be incorporated in the UAE. So if the entities are not incorporated in the UAE, that will not be considered exempt for corporate tax. If they are incorporated into the UAE and satisfying all those conditions under the Article 4 1H, I think, then it will be considered. So B is in the UAE, satisfying all conditions 100% by own ALP, it will be exempt. Exempt person. C cannot be because C is, this is 41H. C is incorporated out of the UAE. D, yes, within the UAE it will be exempt. E, even though this is in the UAE, but this is owned 100% by a company which is not incorporated in the UAE, so E will not be satisfying the condition as well. I think this investment manager exemption, this has been left. Might be you can go through this by yourself, or I can discuss in our any other webinars. So this is over from my side. If you have any question, you are most welcome. No questions? Appreciate you guys. Thank you very much and have a lovely evening. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.